Module 8, Grants, Concessional Loans, and Guarantees. We've spent the last 3 modules on the who, the funds, the banks, the bilateral donors. Now we turn to the how. Because whatever the institution, the money always arrives in the form of a specific financial instrument, a specific type of deal with its own rules about who bears the cost and who bears the risk. And here's the thing. Choosing the wrong instrument for a project is one of the most common and most damaging mistakes in this whole field. A good project can fail simply because someone tried to fund it with a loan when it needed a grant, or wrapped it in expensive support when a simple guarantee would have done the job. So, in this module, we open the toolbox and examine the workhorse instruments, the ones you'll meet on almost every project. By the end of this module, you'll understand the real difference between a grant and a loan, and when each one is right, you'll understand what a guarantee is and how it quietly makes risky projects possible. You'll grasp political risk insurance through a concrete example, and you'll know what technical assistance is and why it's more important than it sounds. Let me begin with the 2 most basic instruments, the grant and the loan, because everything else builds on the distinction between them, and it's a distinction that a climate specialist new to finance sometimes underestimates. A grant is the simplest instrument in the world. It's money given that does not have to be paid back. That's it. A donor hands over funds for a purpose, the recipient uses them, and there's no repayment, no interest, no debt created. In everyday terms, a grant is a gift with a job attached. A loan is money that must be repaid, usually with interest. Interest, if it's genuinely new to you, is the cost of borrowing, the extra you pay on top of the original sum for the privilege of using someone else's money over time. A loan creates a debt, an obligation sitting on the borrower's books until it's cleared. And here's the key idea we built in the early modules and now put to work. Loans come in different degrees of softness. A commercial loan is at full market terms, expensive, relatively short. A concessional loan is softer than the market, and concessional simply means better terms than you could get commercially. A lower interest rate, a longer time to repay, sometimes a grace period where you don't repay anything for the first several years. The softer the loan, the closer it edges toward being a grant. In fact, you can picture the whole spectrum as a slope, with a pure grant at one end, then a very soft near-zero interest loan, then a moderately concessional loan, then a full market loan at the other end. Most climate finance lives somewhere on that slope. So the central practical question is this: when should a project get a grant and when should it get a loan? This is not a small technical detail. It goes to the heart of a fierce and important debate in climate finance, and you should understand the logic cold. Surely every developing country would always prefer a grant over a loan, so why does anyone ever get a loan? Why not just give grants for everything? 2 reasons, one about the project and one about the money. Start with the project. The honest test is, does this project generate a revenue stream, a flow of income that could repay a loan? A solar power plant sells electricity. A water utility collects tariffs. Those projects earn money, so a loan can make sense. The project pays for itself over time, and the borrowed money is recycled to fund the next one. But now think about a mangrove restoration that protects a coastline, or an early warning system for cyclones, or a program to help subsistence farmers cope with erratic rains. These produce enormous value, but they don't produce cash. There's no revenue stream to repay a loan. Forcing a loan onto a project like that is not just unfair, it's incoherent, because there's no income to service the debt. Those projects need grants or the very softest concessional money. That's reason 1. Match the instrument to whether the project earns money. Now reason 2, the harder truth about the money. There is far more loan money available in the world than grant money, because a loan gets repaid and can be lent again, while a grant is spent once and gone. The MDB's leverage trick from Module 6 only works because loans come back. So the system, left to itself, tends to push loans even at projects that arguably deserve grants, simply because loans are what's abundant. And this creates a serious problem for vulnerable countries. They end up taking on debt to protect themselves from a climate crisis they did little to cause. Many of them are already heavily indebted, and piling climate loans on top can push them toward a debt trap, where servicing old debt eats the money they need for everything else. That's why developing country negotiators fight so hard for grants and highly concessional finance, especially for adaptation. and why the grants versus debt argument is one of the defining fault lines of the whole field. We'll return to the debt dimension in Module 10 and to the fairness of it all in the final module. For now, hold the principle. Revenue-generating projects can bear loans, public good projects need grants, and the system's bias toward loans is a real danger for the countries that can least afford more debt. Good, now let me introduce the instrument that trips up almost everyone new to finance, because it's genuinely clever and not obvious: the guarantee. A guarantee is not money handed over at all. A guarantee is a promise to pay only if something specific goes wrong. Let me say that again, because it's the crux. With a guarantee, no money changes hands up front. An institution simply stands behind a deal and says, if this particular bad thing happens, we will cover the loss. Think of it like a cosigner on a loan, the way a parent might cosign so a young person can rent their first apartment. The parent doesn't hand over any cash. They just promise the landlord, if my child fails to pay, I'll cover it. And that promise alone is enough to make the landlord say yes to someone they'd otherwise turn away. The guarantee changed the outcome without a single dollar moving, unless things go wrong. Now scale that idea up to a climate project. Imagine a private company wants to build a wind farm in a developing country. A commercial bank is willing to lend, but it's nervous because it's not sure the project will earn enough to repay, and the country is unfamiliar territory. So an institution like the World Bank's MIGA or a development bank steps in and guarantees part of the loan. If the borrower defaults, the guarantor covers the bank's loss up to an agreed amount. Suddenly, the bank's risk is much smaller, so it agrees to lend, and often at a better rate. The wind farm gets built, and notice the beauty of it from a public money point of view. The guarantor may never pay out a cent. If the project succeeds, as most do, the guarantee simply expires, having cost nothing while unlocking a whole private loan. That's why guarantees are considered one of the most efficient tools in the box. A relatively small promise can unlock a much larger flow of private money. This is the de-risking idea from Module 2 made concrete. You're not paying for the project, you're removing a specific fear that was blocking it. There's a specialized and very relevant version of this called political risk insurance, and it's worth understanding on its own because it addresses fears that are especially acute in developing country projects. Political risk is the danger that comes not from the project itself, but from government action or political events. Let me give you the three classic ones, because they're concrete and you'll recognize them. The first is expropriation, which means the government seizing the asset, taking over the wind farm or the factory the investor built. The second is currency inconvertibility and transfer risk, which means the investor earns money in the local currency, but then can't convert it into dollars or euros, or can't legally move it out of the country, so their returns are trapped. The third is political violence, meaning war, civil unrest, or upheaval that damages or halts the project. Political risk insurance, which MIGA is famous for providing, protects private investors against exactly these dangers. The investor pays a fee, and in return, if the government expropriates the asset, or the currency gets stuck, or violence destroys the project, the insurer compensates them. Why does this matter so much? If a project is good, shouldn't investors just come? Because for a lot of developing countries, it isn't the project that scares investors away, it's the country risk, the fear of exactly those political events, whether or not they're likely. An international investor might love the economics of a solar project in a particular country but still walk away, worried that in 10 years a new government could seize it or trap their money. Political risk insurance directly removes that specific fear. It says, build your project, and if the political worst happens, you're covered. And once that fear is neutralized, capital that was sitting on the sidelines is willing to come in. So political risk insurance is not a minor technicality. For many of the poorer and more fragile countries, it's one of the few tools that can genuinely change an investor's yes or no decision, and it does so, like all guarantees, without spending public money up front. It's a way of lending a country the world's confidence until it has built its own track record. There's one more instrument I want to make sure you respect, because it's the least glamorous and one of the most important: technical assistance, often shortened to TA. Technical assistance is not money for building the thing itself. It's money and expertise for the knowledge around the project, help to design it, to plan it, to write the proposal, to build the institutions and skills to run it. It's typically delivered as a grant, and it's often small compared to the investment it supports. Why does it matter so much? Because, as we saw with the climate funds in Module 5, one of the biggest barriers a developing country faces is not the absence of capital, but the difficulty of accessing it. The accreditation, the bankable proposal, the safeguards, the systems. Technical assistance is what closes that gap. And notice how easily it gets undervalued precisely because it doesn't build anything you can photograph. A minister can cut a ribbon on a solar plant. Nobody holds a ceremony for the 6 months of advisory support that got the proposal written well enough to be financed. So technical assistance is chronically underappreciated and, in tight budgets, often the first thing cut, even though it's frequently the highest leverage money in the whole arrangement. A modest amount of TA to help a national institution get accredited or to turn a rough project idea into a fundable proposal can unlock a very large investment that would otherwise never have happened. Think of it as sharpening the axe before you cut the tree. Skimp on it, and even well-funded projects stumble on poor design and weak capacity. Invest in it, and you multiply the effectiveness of everything else. For a practitioner, learning to secure and use technical assistance well is one of the highest return skills you can develop. Before we combine the tools, let me add one more distinction that matters when a loan is on the table, because it decides how heavy that loan really is for a country. 2 loans of the same size can be worlds apart depending on their terms, and the shorthand for how soft a loan is called the grant element. The grant element is the portion of a loan that, because of its low interest and long repayment, is effectively a gift rather than a true cost, expressed as a percentage. A loan at full market rates has a grant element near zero, it's all cost. A loan at very low interest, with a long grace period and decades to repay, might have a grant element of 50 or 60% or more, meaning more than half of it is, in real economic terms, a gift buried inside a loan. This is why concessional is not one single thing but a dial, and why negotiators fight over terms, not just headline amounts. When someone tells you a country received $100 million, your practitioner's instinct should be to ask, on what terms, and what was the grant element? $100 million at market rates and $100 million at near zero interest over 40 years are completely different gifts, even though the number is identical. Holding that question in mind will make you sharper than most people in the room. Now let me connect the tools, because the real craft is in combining them, and this is where the capital stack from Module 3 comes fully alive. A single real project rarely uses just one instrument. Picture that climate-resilient irrigation scheme again. The core investment might come as a concessional loan from a development bank. The resilience features that earn no revenue might be covered by a grant from a climate fund. A guarantee might sit underneath to bring in a private partner or a commercial lender. And a slice of technical assistance might have paid for the design and the proposal that made the whole thing possible in the first place. Grant, concessional loan, guarantee, technical assistance, layered together, each doing the job it's suited for. Reading a project and seeing which instrument is doing what, and spotting when the wrong one has been used is a core practitioner skill, and you now have the foundation for it. So, to bring it together, the workhorse instruments of climate finance are grants, loans, guarantees, and technical assistance. A grant is money you don't repay, right for public good projects that earn no revenue, like most adaptation. A loan is money you repay with interest, and it ranges from soft concessional terms to full market terms, and it's right for projects that generate income to service the debt. But the system's bias toward loans is a real danger for already indebted vulnerable countries. A guarantee is a promise to pay only if something goes wrong, and it can unlock large amounts of private money at little or no public cost, with political risk insurance, like MIGAs, specifically neutralizing the fears of expropriation, trapped currency, and political violence that keep investors out of developing countries. And technical assistance, the humble grant for design and capacity, is what lets a country actually reach and use all the rest. The real skill is matching the instrument to the project and combining several into one coherent deal. We've now handled the direct instruments, the money given, the money lent, and the risk absorbed. Next, we move to the more sophisticated end of the toolbox, where public money is used not to fund projects directly, but to pull in private capital many times its size. Equity, blended finance, and the leverage that the whole billions to trillions idea rests on. That's Module 9.